The broadcast is now starting. All attendees are in listen-only mode.
Welcome, members and guests. This is Joanne Obata, President of the Virtual Investment Club of Sacramento. We are a Better Investing Model Club open to the public. All of our meetings and stock studies are virtual, allowing us to have members from around the world and the U.S., including Canada and China. Guests, you will be muted during the meeting as observers and will have an opportunity for questions and comments once the meeting ends. The stocks presented today are for educational purposes only and are not intended to be a recommendation for buying or selling any stocks. We ask that you conduct your own review and analysis of any company of interest before making an investment decision. The views expressed are those of members and do not necessarily represent those of Better Investing. This meeting may use products or services not endorsed by Better Investing or the club. This meeting is also being recorded for future use and will be posted to our YouTube channel. I want to thank our members for reviewing and discussing the quarterly reports in the online discussion threads before this meeting. We usually have discussions during the meeting, but we have to do something new today since we have 11 quarterly reports as well as stock studies and only an hour and a half to complete them. Each stock watcher will give their recommendation for buy, hold, or sell and the reason why. We will not have any discussions during this meeting for quarterly reports. We have only a limited discussion time for this meeting. Based on feedback, members would like to have discussion time during the meeting, so going forward, when we have so many quarterly reports, we will not have stock studies to allow for discussions during the meeting. Jane will be rescheduling any stock studies that are scheduled to happen when we have so many stock studies. We are using a timer to ensure that everyone gets a chance to present the report. You can see it at the bottom of your screen, and to end the meeting on time. Once the time is up, you will see a yellow flashing, and that's a 5-second warning, and then the next presenter will be up. Please stop your discussion once you see the yellow flashing and it passes on to the next presenter. Any extra time will roll over to the next presenter. Any questions will be handled through the discussion threads post-meeting. Next up is our treasurer's report from Hanny. Oh, I got to can somebody make him the presenter? Jay, can you make him a presenter? Or Hanny, can you make yourself a presenter?
I think it's starting. I did. You can see it? Okay, I'm going to go to full screen. I will do this very fast, so if you have questions, maybe send them by email. First of all, looking at our portfolio diversification, I took this into looking at the sectors, industries, and companies. You can see that with respect to sectors, we're heavily weighted towards technology and industrials, and those are represented by Skyworks, IPGP, and Facebook. The next sector is industrials, represented by FleetCor, Hyco, and Middleby. So we don't have any sectors in the consumer defensive or utilities. With respect to company size diversification, you see the chart on the left, micro and small companies should make about 25% of the portfolio. Ours is at 12.3. Mid-sized companies should ideally be 50% of the portfolio. We're approximately almost 55%. And large companies should be about 25%. We're at 22.2. We also have approximately 11% in cash that has not been deployed yet. This is just our portfolio performance, and I've compared it to the SPDR S&P 500 ETF, SPY. Now, I did something new this month, and that is looking at what's called annualized money-weighted rate of return, which I can explain at some point in the future. But basically, it takes into account cash flows and outflows in a portfolio, as opposed to the time-weighted rate of return. So you can see that we started out in May of 2016. That's when the club started. We started out with $1,000, and currently our portfolio is valued at about 25,000. We bought 20,000 roughly worth of stocks. Our gain loss since that time is about 24%. The average compound annual growth rate of the companies that are in the portfolio, I did a CAGR individually and then averaged them, 17.9, and the money weighted rate of return annualized is 8.83%. And then
Can I have a question?
No questions, sorry.
Okay, sorry. Why is it red? That's all I want to know.
You'll have to get permission from Joanne.
Yes, you have 4 minutes, Danny.
I still have a few more slides.
Why is it red?
Oh, it's just highlighting
Thank you.
the difference from the SPY ETF. So I just wanted to kind of look at why we're not doing so well in certain areas. And again, this is the SP 500 SPY ETF is the horizontal red line, and the companies on top, Middleby, Realty Income, Public Storage, and Skyworks, are that's the performance since August 2017 relative to that ETF. And you could see on the right-hand side here, they're down from that. So if we were basically, bought that ETF and put the same amount of money in each month versus these, that's what the returns would be. Now, the Realty Income and Public Storage, I think because of interest rates going up, that's probably why you're seeing a decline. But the other two, I'm not sure why they're going down like that. The other, I also looked at Biogen versus PowerShares QQQ, which is the NASDAQ, because it's traded on the NASDAQ. And again, you can see the relative performance. Disney versus SPY again, you can see the relative performance. And Bank of the Ozarks versus KRE, which is a regional bank ETF. And again, that's where it's at. So my recommendations: consider adding stocks from consumer, defensive, and utilities. Consider adding small and large company stocks. Review underperforming stocks, Middleby, O, PSA, and Skyworks. And also take a closer look at Biogen, Disney, and FleetCor. And that's it.
Okay, question. What does the money weight? Okay, money weighted mean? There's one slide about money weighted.
Yes.
Like our percentage was lower. Is it good or bad?
It's bad.
Okay.
So basically, the money weighted is it's an internal rate of return. You calculate how much money you're putting into the portfolio, and then you look at the starting value and the ending value for whatever period, and make sure you include all of the inflows of cash. So each month we put in $1,000, and sometimes that money is deployed, other times it's not. So when it's not deployed, it's not creating a return. So that's why it's basically lower. But in addition to that, a number of the stocks haven't performed well relative to that ETF. So that's why you're seeing a lower performance.
Question. That was a negative 17 or a positive 17 for 2 years? The first slide?
No, there are two different things. That's a positive 17.9. Okay. That's the average compound growth rate. So if you take the performance for a certain period, sure. So for example, let's say last month we bought Facebook. So I took the performance of Facebook since we last bought it, which is only 30 days, and then extrapolated a compound annual growth rate going forward. I did that for each of the stocks, but based on when they were purchased, and then averaged that number, and that came to 17.
But so you've outperformed the S&P is my only question, right?
That's correct.
Yeah.
So
okay, thank you.
Using that calculation, which is somewhat misleading. So a more accurate calculation is this last one, the annualized.
5 seconds.
Yep. So Joanne,
Oh,
in case you
really?
haven't figured.
Oh.
Okay, next is Jane up for, or Tom for the stock study.
So in
Can-
case you haven't figured it out, Joanne, this was my nefarious way of getting more airtime next week because everybody's
Okay.
asking about this.
Yes.
I have
Okay.
a question. I still have a question. We can
Okay,
talk
I'm
about this
switching it over to, is it Tom or Jane that gets the,
Very good, Haney. Very good.
Yeah.
okay,
Thank
Tom,
you.
I'm switching it over to you.
Okay, so Biogen?
No, your stock study.
Stock study.
Oh, sorry. I thought that was the way okay. Okay, well, I can start here, I guess.
I make a Tom presenter.
I studied.
Wait, yeah.
I make a Tom presenter. Go ahead, Tom. Sorry.
Okay. Can you see my
Yes, we can see.
my report here?
Yes.
Okay. So I studied Alibaba, and it's a Chinese company.
Can you give us an industry overview before you start in on your stock?
I don't really have an industry overview.
Okay.
They're both technology companies, both pretty much internet companies. They have different areas that they operate in, but most of their business is online. Alibaba does have some physical retail presence, but Alibaba's the closest competitor I think that we would be familiar with would be Amazon, but they're in different hemispheres. So, but that's some of what they do. So anyway, they're the largest e-commerce company in the world. Their biggest source of revenue is from transaction fees on sales of merchandise through they have Taobao, Tmall, and however you say it, Juhua Swan. And then they generate fees through hosting cloud computing, retail sales. They have some presence there, logistics, online video, and their payment system, Alipay. Sales have grown an average of over 40% for the last 5 years. Earnings have grown over 20% for the same period. Pre-tax profit margin has been about 40% the last few years. Well, return on equity's been around 17%. As far as project, I went by analyst research as far as projecting the future sales growth. I chose 25%, which is a little more conservative than the analysts. Morningstar and several of the other analysts were predicting around 30% sales growth.
Wow.
Which is amazing, but they've grown 43% over the last 5 years, and they're guiding for 60% next year.
Wow.
So, which is just you think that's unsustainable for sure. But they're I guess they're getting still expanding their business in China, and they also bought this company. I didn't write down the name, but where they're going to expand in Southeast Asia. So, they're going to expand their market, and they're going to increase cloud, their cloud computing service. And I projected through the preferred procedure almost 30% earnings, and I used all the default values except I lowered the pre-tax profit margin to 38%, which was like, I think about the most recent year was is their pre-tax profit margin seems to be going down. But also, they could, if they make new investments, that could lower their earnings. But I'm just thinking about Amazon. Amazon doesn't make any money, but their stock is valued really high, and everybody thinks they're a wonderful company, even though because they spend everything they get. and I chose the high and low PEs based on that. We can look at the SSG here in a minute. I chose the averages, but 2014 was an outlier. It was way too high. So let's see here if I can. Let's close that. And I don't know. I thought I had my SSG up here someplace. No, that's Biogen. There we go. So I don't know if I can make that any bigger. So anyway, this is my stock selection guide, and you know, I just discussed these things previously here. These are the values I used for the preferred procedure. You know, like I lowered the pre-tax profit margin to 38%, kept the tax rate the same. You know, I don't know how taxes work in China, and I just kept the default value for the shares outstanding. And they don't pay any dividend. And there's the pre-tax profit margin. See, it's been all over the place. So I know I just chose 38%. It's about consistent with the last couple years. And so then, but you know, like Joanne brought up, I guess because the growth rate is so high, the forecast high price is like over 500, which I think I forget what it was. I think it was a little less than 300 for the value lines projection. And so that comes out to, and with these assumptions, which are, I don't know, on the one hand, by BI principles, they're pretty outrageous, you know, especially the growth rate and everything, but by, you know, this company's history, it's a little bit conservative. So anyway, it comes out to, with these assumptions, a buy with a 3.3 to 1 upside downside ratio, a total return with a high PE would be 23% annually, and 17.6% with the average PE.
Tom, if you mentioned that they may be making some investments, and as they grow, they're going to be less efficient. If you were to reduce the pre-tax profit even further from the 35, I think you said, what would
I brought it down to 38. Well,
38.
it's, you know, well, you can put in anything you want, you know. I mean, bring it down to 30, it's going to decrease the return.
Yeah, if you go to the pre-tax profit tab, and say we pick like a 27 or something, what would that's the 2011. Still.
Well, that's going to bring the growth rate down to 21%, and that brings it to upside downside like less than 2 to 1. Yeah. But
they're trying to, like Amazon, put a lot of money back into the company. They're not looking at earnings quite as much, so they're trying to follow that model more recently, and that's why their earnings have been somewhat lower. So I don't know if that matters.
What is this? This is a Chinese company.
Yes.
Is it an ADR? Is it an ADR?
Yes.
Yeah.
What's ADR?
It is an ADR.
Well, yes, we can buy it as an ADR.
Deposit return, a register.
I think it was a receipt.
Oh, receipt. Okay.
Yeah.
But yeah, it can be bought and sold on U.S. markets.
Tom, I have a question about AliExpress. Do you have any insight into that? I just read an article about how American, like, small business is trying to do have an online e-commerce market, and they drop ship through AliExpress, but the quality of the product isn't always that great. Have you heard about that?
They purchase or they sell through AliExpress?
It gets drop shipped through AliExpress So they must have some kind of agreement.
Well, you know, honestly, maybe Jane knows, but I'm still unclear that if you're asking, are U.S. companies buying or selling through AliExpress?
I think they're buying. Oh, go ahead.
I think what Joanne was saying, they are buying through AliExpress, and the product will be shipped from China to US. And when they receive it, they don't seem to be a good product. Is that what you're saying, Joanne?
Yeah, and when it comes shipped to them, so say like ABC company sells a product, it gets drop shipped from China, and it has you know, Chinese tags on it, and it comes from a Chinese address. It doesn't come from the company itself. They're just kind of like a portal.
Well, was that the sweaters?
Yeah.
Or
Did you read
hoodie?
that? Yeah,
This hoodie?
Yes,
You know,
yeah.
I glanced at it. I didn't see that it was through AliExpress though, but okay.
Yeah, and I had heard a podcast about how somebody was doing watches.
Well, there's fraud. There's, you know, I mean, the Chinese companies, to an extent, it's kind of Wild West. You know, we're not certain about the accounting, and there's supposedly a lot of counterfeit goods, and you know, I mean, it's not up to the standards of U.S.
I have some personal experience with that. So our company buys a lot of equipment and engineering type equipment, power plants and things from China, and you can get pretty good quality, or you can get, you know, you can order you know, a microwave and get a toaster, right? But at the same time, if you're diligent and you have in-country quality surveillance, you can often get what you're looking for at a reasonable price. But I think in the consumer goods section area, you know, it's luck of the draw. There are some good companies and they're not so good, and it just depends.
Okay, thank you.
So I'm not sure if Alibaba is doing any sort of due diligence on, you know, the vendors that sell through their website, but that might be something they want to consider in the future.
As far as I understand, I don't think they do due diligence, and that's one of the issues that I'm concerned with. So I haven't really. I mean, when the price was good, I was considering buying in, but that was one of the biggest issues I was concerned with.
Mm-hmm. So they went IPO in US in 2013?
Yeah.
Okay. So can we take a look at the quarterly data?
Not 13. I think, is it 2 years ago?
2 years ago, because I see Tom crossed out some data or on the first tab. That's why I was wondering.
Well,
No,
it was. You know, I crossed out those years because it was. I can put them back in, but you know, they were like they weren't making any money, and
I want to give Jane time for her presentation.
So
Can we switch it over to Jane?
Yeah,
okay.
so because no data, that's why I thought they went IPO 2013. So I'm wondering why they has no earnings in 2011 and 2012.
Jane, are you ready?
Accounting magic.
Okay, I'm transferring to you.
Okay.
Yeah.
Okay.
Can you transfer to me?
She already did.
Yeah.
You just say yes.
Can you see my screen?
Not yet.
Not yet.
Oh.
Did you accept the?
You need to push.
Can you do it again?
Okay, or something.
Okay. Yeah. Sorry. Are you there?
Yeah, we're waiting.
We're here.
We can't see you.
But then I can't see. I mean, how do I make myself a presenter? Can you make it again?
I've already made you presenter. Did you get a screen that says accept? A dialog box that says accept?
I guess I click it, but I don't know how I did it. Can I have it again?
Okay, I'm gonna. I'll switch it.
Switch back. Yeah, switch.
Switch
So
back.
meanwhile, yeah, you guys figure out. So yeah, 巨划算
Here,
的
right,
when
here we
that.
go.
Oh, I got it. Okay, there
No,
you go. No.
no, that's
So you
she's
switch
got mine.
Yeah.
So I gotta give it to her.
Right. So 巨划算, Tom, what you said, it means super. What 划算 meaning bargain. It's in translation. Super bargain. 巨划算, the company you mentioned early. Anyway.
Oh.
Jane, do you see the dialog box to accept it?
Yeah. Can you see my screen now?
Yes, we can see your screen now.
Okay. I'm sorry, I didn't do an industry report. I should have done that. But then, I mean, to save time, we go straight to the company. And I think when Tom and I discussed what company to study, we did study a few companies until we come down to Tencent and Alibaba. And because I think these two companies have great growth potential, and internet is really growing in China. It has been, a very fast growing industry. And I think it's worthwhile because I think a few months back, I think Matt was really interested in Alibaba, but at the time the price was really high. Until now, I think it's a good time to look at these two companies. So Tencent is China's largest internet content and service provider, and basically it connects users to a variety of internet services and contents. So it has two social networking platforms. One is WeChat, the other is QQ. And QQ is a very, it's the first one to announce, I believe. And then it comes the WeChat, and WeChat is so popular. I mean, I moved to China, Shanghai, back in August last year, and I just cannot imagine that everybody is using WeChat. Just like everybody is using WhatsApp in Hong Kong, but in China, WeChat is the one that people use. So basically, as of March 31st this year, the MAU, the monthly active user, exceeding 1 billion. And the total population in China is about 1.4 billion. So penetration rate is quite high. So the company's strongest distribution capability is in various platforms. One is online gaming business. And can I just scroll it down to the next page to show you? So one is online gaming, and the other one is the social communication. Apparently, everybody is using WeChat. And the media, they have videos, they have news feed, they have music, and the payment, the mobile payment is really popular. Of course, the Alipay, the Alibaba also has a Alipay, and they are pretty competitive. Even though Alipay still has a higher penetration rate, which we will look at later. And the App Store, they have a lot of products online as well. So as you can see from this screen, they are number one in all aspects, in all these areas. So that's why they have the dominant position in China, and they have a very wide moat supported by network effects, because they have such massive user base, and also they have their own intangible assets. Like they have a vast collection of user behavior data, and they own content, and they own the IP. So in other words, if anybody who wants to switch to another platform, it will be very, very inconvenient, because if they switch, then all these social networking, the content consumption, and the payment, many of these are not in one platform like WeChat. So WeChat basically have everything in there. So if they switch, they will lose the content they have built in WeChat and QQ, as well as the content they post they will lose if they leave the social networks, and the merchants will also lose the connection to their customers. So the switching cost is really, really high. So that's why they capture their customers in a way. And the historical sales growth rate is about 45.3%. I would show you the SSG on screen, and the historical EPS growth rate is about 38.1%. And so I used, to be conservative, I use 40% as the historical sales projection growth rate. And for the EPS projected growth rate, I picked 38.5 because I went through the preferred procedure. And so I plug in the 40% for sales, and I look at the pre-tax profit margin. So I look at the previous year, so I picked 35%, which is more prudent. And then for the taxes, I picked 18.5, just by looking at the average. And then I get this 38.5. So with that, then you see the pre-tax profit on sales is going up. The return on equity is also going up, uptrend. And on the other hand, the debt to capital ratio is going up throughout the years. But however, if you look at 2017, it's actually lower than 2016. So in a way, it's not going up, it's actually coming down. So we look at the projected high price and low price. So if you look at the previous PE for the past 5 years,
Jane, you need to go to the next page.
Is the next page.
Oh, we're looking at your sales earnings, but you're talking about high price, low price.
Oh, sorry, I'm already here, so I don't know why the screen is not changed. Can you see me?
No, we're still looking at sales and earnings.
Oh, how come? Because I'm already on the second screen.
Valuation and return? Oh, maybe there's a delay.
Okay. So you look at the high PE for the past 5 years, they are pretty consistent. So I didn't cross out any outlier, and also similar to low PE ratio. I mean, I didn't cross out any outlier because there are none. So the average high PE is about 46 for the past 5 years, and the low PE is about 25.6. And so to be prudent again, Haney asked me why I take a 0.9, 90% just to be prudent. That's one number I pick up. I just divided 46 by 90%, so I get 41. So that's how I get this 231.9 as a high projected price, projected high price. And similarly, I use 90% of the average 25.6, so I get 23, and then I get the projected low price of $25.5. So with that, then we get this the upside and downside of 7.7 to 1, and the annual projected return based on the average PE is about 30%. Any question?
Yes, I felt that your sales projection, I felt very optimistic. So historical, can you go to the growth and quality, the first tab? So historical 5 years is a 45%, and so we're projecting, say, next 5 years they can sustain that growth rate and to be 40%. I felt it's very optimistic.
Yeah, we can try to play around with it, but
right, I think you have room. Even though you cut down to 20%, I believe it can still be a good investment. I'm just curious because right now price is at about 49, and we are projecting the future 230. Yeah. Are you switching, or is still there's a delay?
No, I already switched to the first page to show you the preferred.
Okay, so there's delay then. Okay.
Yeah.
Jane, a question along the same lines. In your report, you were mentioning that they have over 1 billion users and there's 1.4 billion people in China. I'm assuming that most of the people that have access to internet and cell phone and so on have already, subscribed. So, along what Jay is saying, do you still think that you can get 40% growth?
Yeah, because I haven't finished my presentation earlier because there's a network effect. And as I briefly mentioned, the switching cost is so high, and the network effect is actually not only for the inconvenience of leaving and switching to other platforms. It's actually the more user they have, the better. Yeah. And I know what your concern is that penetration rate is already high and there's not much room for growth. But on the contrary, the more users they have, they are going to have more merchants to participate because the merchant would like to look for customers that they already captured in their platform. And they open up, if I can show you on the second page of my write-up, they open up the online gaming to third-party online game developers. So they have a lot of merchants like game developers for online gaming sector, and they develop a lot of online games. So the more resources they have on the platform because of their massive user base, the more merchant will be attracted and more user will be further attracted.
Jane, I have a question. So is there growth coming from monetization then? So for their based on advertising because they have such a big user base?
Yes. Yes, not only advertising. Actually, advertising is one area they haven't fully developed, as I show in my write-up. They compared to peers, their advertising revenue is still low. So that is one sector they have a lot of growth room to grow. And for example, they develop some mini programs. Those mini programs are for advertising as well as for e-commerce. And if somebody, for example, if somebody wants to do business online and they want to capture all those users on WeChat, so they would use their mini programs and they pay a small fee, and the mini program will allow them to reach to all these users, and they can sell the products through the mini program, and the mini program will collect the fees for the merchant. So everything is so automatic and so convenient that even though they collect a fee, the merchants are still willing to use those mini programs.
Can I ask a question about? I'm sorry. Go ahead. I had a question about your PE. You said that the returns, according to the average PE, would be the number. I don't remember exactly, but then you're way above your average PE right now.
Right. So, yeah, PE. Can we also fix the sales first, and then go back to the PE? Because I would still like to reduce the future sales.
My average PE is 41.
Okay, so I thought it was. Well, can we go back to the
SSG?
I thought it was.
Yeah. I have to say WeChat is the number one, the only, the most popular social media in China. That's so true. But I just felt like a sales. I want to understand about future growth as well. Based on what Jane was saying, the future growth.
Okay, we have 1 more minute.
Future growth come from.
The SSG is not coming up though.
Yeah. Your SSG is not coming up.
We can adjust the future growth to a level that you feel comfortable
I feel
with.
like cut down in half, 20. Of course, it could be 45, but I want to see what if I make a very conservative, projection. Let's say 20%. I believe it could be still in a buy, actually. Yeah.
I guess my point is you're still way above your average PE. So does that mean anything to you?
Right. Can you go to PE now?
You see, you're 35 and 44. Your current PE is 44, and your average is 35, 36. So does that mean anything to you?
What do you mean? My average PE is 35.
Well, the average price earnings ratio is 35.8 on your SSG right there.
Hey, 5 seconds.
And you use
then
that
we
to
have, and then
calculate your return.
BIIB's up.
So
The average PE
Okay.
for yeah.
Sorry, I'm cutting you off.
So we can talk about this after the meeting. Let's continue that discussion and finish.
Okay.
Yeah, let's continue the discussion.
You're up for BIB.
Okay. Well, the BIB is Biogen. They're a biotechnology company. We've the current the SSG I projected 6% sales growth and 7.1 EPS growth. I think I changed that a little bit. Maybe it's a little bit lower on the EPS growth. So the most recent quarter, you know, going by the different columns on the quarterly data, they grew about 11% sales, but that's actually 15% year over year because if you can take out the hemophilia revenues, but they still haven't, they spun off that hemophilia business. Are we haunted?
Jean, no, it's not you. Jean, can you mute your microphone? Because can you?
So anyway, it's 15% if we throw out the hemophilia, and which is probably more accurate. And the pre-tax and these other figures, I think, you know, I couldn't quite figure out the. These are like, I think we should ignore these figures. It's 47% and 60% pre-tax profit and EPS growth. The company gave non-GAAP, where they did some adjustments, which, you know, I would say 16% is they put it in when they do non-GAAP, they put stuff in a favorable light. You know, they tried to, you know, compare year to year, but then they take some liberties there. So anyway, the current PE is 19.2. So they're selling a little bit below their average PE, and upside downside ratio comes out 5.8 to 1, compound annual return 16.6%, and that is when I reduced the low price to 216, which is 80% of the current price. Well, this says 269, but it's up to 278 today, so, you know, pretty close. So anyway, as far as how they're doing, their main drug, Tecfidera, is facing increased competition. How am I doing on time?
Seconds. Next up is IPGP.
Okay. So anyway, maybe I spent too much time on that. They're facing competition.
Okay. I'm switching you.
Your final recommendation is what? Hold?
It is hold and hope for the best.
Okay.
Okay, IPGP, you're up.
That will be Mina. Yes.
It would be nice to be. I don't know why I wasn't able to see the clock, but it would have been nice to know that.
Okay.
Go ahead.
Okay, yep. So IPGP, it's an equipment and material company focused on the manufacturing of lasers for larger scale manufacturing. So they create the lasers and systems for that. So a lot of technology clients. They had a very strong quarter. They grew about 29% from the previous year end, delivered record first quarter revenues and earnings. They project for an annual increase of 13.5%, so we put that in the SSG. And then
can I pause you for a second? Mina, can I pause you for a second? We read your report. So sorry, reason why you have SSGs up, I think Joanne wants, are you recommending to sell this company?
Well, so the thing is, the company keeps, I hesitate with this one because the company looks like it continues strong. It's growing well. The issue I have is the price of the company. Value Line projects that the low price for 2018 can go 10% below the current price, and then up to 360, I believe, was the high end. So I just worry that given that they've had, you know, it seems to be a record year. They grew at 40% last year, and then a very strong first quarter. That if any kind of cooling in that growth will result in a drop in the price, and if it's worth just taking the profits that we've earned pretty significant profits that we've earned on this company already, and investing it somewhere where we think we'll have better earnings. So I recommended more of a hold and see for probably the second quarter to see how their growth is for first half of the year. And I mean, if it's continuing at the rate that they're going, then I would actually recommend to keep the company and potentially buy more. But if there's a cooling in their growth and their momentum, then I might recommend to sell then. So I think I put in my report a hold with an eye to selling this company.
Okay.
So I think it depends on your philosophy. If you want to take the profits and then invest them somewhere else, or if you think that this company is going to keep growing. I mean, it just.
Okay, can I take a look at the sales again, Joanne? So
I apologize. This is the wrong stock study, and I don't know if did you submit an ITK?
Yeah, I uploaded it into the.
He actually uploaded just before the meeting.
Sorry about that. Yeah.
Can you go down? Can you go down a little bit? I want to see the sales. I want to see that company's number. Oh,
but this is the wrong. This is the wrong one. Okay, yeah. Disney's up next. Sorry.
So you need just refresh data. We'll get the 2017. I just want to see the data.
If we have time, we can go back.
Okay.
Disney's up.
All right. So going briefly through Disney.
Okay.
I'm gonna pull up on my screen the just the.
We're not switching.
We're not switching. Yeah, no, this is just for my reference.
Okay.
Like I'm not gonna.
Okay. Good. Okay.
SSG. So looking from last quarter to this quarter, sales growth projections, they went from 7 to 9 or 7 to 5. EPS stayed the same at 9%. Trailing 4 quarters, year-over-year sales growth went from 9.1 to 2.5. Sorry, for recent quarter was 9.5. Trailing 4 quarters was 2.5. PTP percent change was from 4.7 to negative 3.8. And then year-over-year EPS growth, recent quarter was 30%, and trailing 4 quarters 30.8%. So overall, it was a very strong quarter for Disney. The only result that was in the negative was the PTP percent change from the trailing 4 quarters, but this was the case as well last quarter. So this quarter did not contribute necessarily to that negative value. And then in terms of the offensive perspective, the current PE, we're looking at 13.6, average PE of 18.3, relative PE of about 0.74 with an upside downside ratio of 4.3 to 1, and a compound annual return using the forecasted average PE of 12%. Again, very healthy numbers. Disney performed very well, and I recommended a buy just because of the fact that they have continued to see lots of growth in terms of the fact that they have made significant progress with the 21st Century Fox acquisition. They've also been doing very well in terms of their digital apps, strengthening its digital distribution with ESPN, and they're very well positioned for the next term coming up. And their shares have actually been ranked to outperform the broader market averages in the year ahead. So overall, very healthy company, and I would recommend to continue to buy more of it.
Okay, a question. The sales earnings, did you make new adjustments? I can't remember.
Yes, so my adjustments in general, I use the value line projections.
Okay, so you increased or lowered? You increased. Can I see the bottom? Okay, so I don't remember. Did you lower or up increase?
These are lower. I also these are, I think, my first draft. I did lower it, I think, as well a little bit.
5 and 9.
8.5.
Okay.
For 8.5 for historical EPS. Sales was about 5, and that was about the lowest I went, just because value line, I believe, had put it to 5.2 if I remember correctly. But you can go a little bit lower. I did try a bit lower, and it still wasn't a buy zone.
SW Skyworks up next.
Skyworks not here.
Okay.
People can use Roy 3 minutes.
Let's see what Roy's.
Roy, as a recommendation on Skyworks is a buy. He submitted a while back. I'm looking at his quarter report. He did not said the reason why. Skyworks, maybe Joanne, you can talk about Skyworks.
I don't have Skyworks stock, and I don't really follow it, so.
Okay. So
sorry.
Yeah, Skyworks
okay.
Recommendations buy.
Okay, let's go on to Facebook is next. They get extra time. Who's Facebook? Oh, no, wait.
I vote that we share the time equally, Joanne.
No, it rolls over. It rolls over.
Rolls over. Okay, FaceTime is an interesting one. Gets extra 3 minutes. Go ahead.
Facebook.
Facebook will be Jane. Is she muted?
Yeah, Facebook has a good quarter, and in fact, it's better than last quarter. And if you look at the, can you scroll down a bit?
I'll scroll down. Okay.
If you look at this quarter's sales growth rate is about 49%, and the trailing 4 quarter is about 47%. So it's actually doing better gradually. And the PTP, the pre-tax profit percentage, has been pretty stable, staying about 65%. And the earning EPS growth rate is about 62.5% compared to 53.5% last quarter. So it's actually better than last quarter. And the price has been coming up because it went down to, if I remember correctly, it went down all the way to $160 not too long ago, about a couple of weeks ago. So now it's coming up to about
184. Yeah.
184. Okay,
Yeah.
184 now. 184 as of today. And the current PE is about 27.4%. 27.4. I used 27.4. Did I? Okay.
No, she got some old data. Yeah. Yeah. Okay. So go ahead, Jean.
Okay, yeah, the current price, based on the price when I studied it a few days ago, is 186. So based on that, the current PE was 27.4. So if you look at the screen now, if I take out all the outliers, then the average PE, high PE is about 36, and the low PE is about 23. So again, to be conservative, I use 30. So for high PE, I use 29. Can you make it screen a little bit bigger?
You can do it.
I can do it. Okay. Anyway,
Yeah.
so I use high PE of 29 instead of 36, and I use 18.8 instead of 23. So the high price that I projected is $645, and low price is $115. And can I go down to the screen? Go down a little bit.
Well, but if I can just say one thing, we're not recommending that we buy more, right? Because we already have 14%.
Yeah, I think what I'm saying is that it's still in the buy range, but I don't recommend to buy it because we have a big position, and it's still a company that we should monitor closely because of the same reason I've been summarized in the past few quarters. Because if the management has put in a lot in R&D, and those investments may take time to materialize. So in the short term, their revenue may not increase significantly, but their earnings per share may suffer a bit because of all the investment put in R&D. So in that case, we still should monitor closely, and I really like the company, and they have very good financial strength. It's ranked A++ by Value Line, and they have very healthy balance sheet. So I like the company, and we continue to monitor. Yeah. And when there's a good time,
can we move on to Ozark now?
Yeah. Thank you.
Let's see, wait. Skyworks. Sorry, I got these out of order. Okay, Ozark. I know Jay was helping Bernard on this, so maybe. Bernard, are you there?
Yes, I'm here.
Okay.
And well, wait. Let me see if I can go to. Here's my. Let me go first to the report, and you can see my report.
We're not going to the reports. You can just speak to it. What we're looking for is if it's a hold, buy, or sell, and the reason why in the time that you have.
Well, I see it as a buy, and for several reasons. Like they've gone from one town in Arkansas to now they have branches in 10 states. And so there's a 12% sales growth, 10% profit growth, estimating conservatively. And the dividend is 1.6%, but it's growing about 15% a year. And so I think it's a good long-term investment. And are you guys seeing my screen now or not?
No, we're not switching. We're just listening
No,
to you say.
we're not sharing screens because we have only 3 minutes per stock. So you have to speak to what's the SSG that's showing.
Oh, okay. So
That's made bigger.
Okay.
Okay, so that's okay. I see the SSG now. I was looking at my own, but so that's just in a nutshell. It's they continue to grow. Now there's new issues. In July, they will be changing their name, Bank OZK. Bank OZK. That name has been in focus groups. It's accepted by their users. They feel they have a good brand name. They want to keep their current customers, but they want to make it easier to expand. So that's what the logic behind changing the brand name. And in July, the name, if they get permissions, which they expect that they will, the brand will become Bank OZK. And their symbol, their ticker symbol will become OZK instead of OZRK. Now that's going to cost them $15 to $25 million. Changing their name is going to be initially going to be a cost, but they want to do that. Another issue came up in the earnings call. The question became, well, are you guys going to be repurchasing your stock? And the chairman said, no, we're not repurchasing stock. We use all our capital to invest and expand for the future. We're not just buying back stock. So anyhow, that's kind of an attitude, but so all in all, I think it's a good long-term buy. And since if we have a lot, maybe we just hold it. But if we don't have a lot, it's a good buy. And the percentages that I can't see, but the long-term,
5 seconds, Bernard.
The long-term returns are 16% or 20%.
I'm switching to FleetCor.
Okay, FleetCor, I believe, is a financial services company. Basically, I have to read this because it's so hard to say in simple terms, but it's a leading independent provider of fuel cards and payment products and services throughout North America, Latin America, and Europe. They are slowing their growth down, so that's why you see the forecast for sales and earnings are going to be decreased. And basically, I had to, is this mine?
Was it not the right one?
Is that FleetCor? Because I eliminated maybe that's in the second page. Because I eliminated a lot of, that's second page numbers, yeah. So anyway, no, they're not eliminated.
No, you got an old one. Oh wait, sorry, I'm not sure.
I-14.
Yeah, well, let me just talk about it qualitatively. Okay. Then they used to have a growth rate of about 25%. Now they're projected to have a 17%. So basically, I took away the last 3 to 4 years. Only had a couple numbers left because the price earnings ratio is not going to be as high as it was in the last 4 years. And if I can open up, I can't look on this and tell you let me look on, see if I can find mine and tell you the bottom line. The bottom line was it's in the buy range. It's supposed to grow at 17%. Upside to downside, I think, was about 4 to 1. And their growth is mainly going to start to come from other countries. They're also expanding into other areas. In Brazil, they're doing toll booths payments. They're looking for payment card systems for lodging for the people on the truck drivers and the fuel system. They also have a contract with FEMA, so if you need a lot of lodging for FEMA, so most of their growth is going to come from new areas. Listen to the conference report today, and that's what they're looking to do, is to really expand out from just doing these fuel card services. So let me see if I can look on mine real quick and give you the answer.
So, Henny, did you say FleetCor is underperformed in your treasurer's report? Do you remember? Or was it MIDD?
Yes.
Okay.
Well, it's up 70% from last year. I don't know how it underperformed. It's supposed to have done great, but maybe it just underperformed when you bought it.
Yes.
No, it didn't.
Annie, are your numbers not including the dividends?
What? Oh.
Oh, no, they don't have dividends. Oh, sorry.
The numbers do include dividends.
Okay.
Yeah.
Yeah, it's actually not opening up on my other side. It says there's a problem with loading this page.
Yeah,
so,
I was looking at your side. I found the same. Yeah, you just refresh.
Matt's not here for MIDD if you want to use his time.
Yeah. Well, the bottom line is that even being very conservative, cutting down the high and the low PE, the only thing is the average PE turned out to be about 20 and the PE right now is 23. So I don't like to buy above the average PE, but because I was so conservative with everything, I think that if you didn't have other things to buy that you were really impressed by, I would probably go ahead and buy this stock with a pretty good I think it's like 4-to-1 upside ratio.
Yeah.
John, do you think if they're expanding internationally,
they are.
And that's gonna be a big area for them?
Their growth it's already increased from like 30 to 40% this year internationally. So it's getting close to half of their sales is international. They want to expand into 20 of the major GDP nations in the world is their ultimate goal.
So you mentioned Brazil being one. Is there a risk of foreign exchange risk with that kind of international growth?
There always is, but I don't know. I can't say how much that'll affect their overall growth because they're in many places and every place is going to have some risk, but there probably is. I just don't know exactly what it would be.
Yeah, I agree. This risk, foreign exchange risks always exist. I remember IPGP one quarter did not do well because it was the foreign exchange impact. So. Yeah,
if you look at that, I mean, I can see the SSG for FleetCor and all the lines are going straight up, but it looks like over the last 3 years, it could have sat the same price, but the sales, pre-tax profits, and earnings are all going up straight. So there seems to be a lull in there, and I can't tell you why, but now it's in the higher range of those 3 years, and they're optimistic going forward.
Are you sure FLDs underperform or is MIDD underperform? Henny.
Relative to the index, it underperformed relative to the index.
Okay, got it.
I think again, it's if you could see the graph, you could understand that although all those things are going up nicely at like 20% rate, for some reason the price sits in a 3-year range with kind of on the same line. Right through here. So now we're on the upswing. So why it had a great up? I think I don't know what happened here, but as you see, the earnings and the pre-tax, everything's going up. So I can't understand why the price here faltered.
Yeah.
It may be because it's saturating the American markets and they hadn't started to develop into the foreign markets as much, but I couldn't tell you for sure.
Okay, so your recommendation is a hold?
No, I recommend it.
Buy more. Oh, okay.
Buy.
Okay, got it.
Other things, it's a little bit, the earnings numbers differ from quite a bit, and that's my only reservation. But if we have money and there's nothing else that looks great, I definitely think this is a buy.
Yeah, if it's underperform, yeah, okay. Okay.
Yeah. Only the price is underperformed. Everything else is done well.
Yeah.
There you go.
This reminded me of one company was like that. The fundamental everything looks great, just the stock price was just not going up. It was like that.
But maybe later.
Yeah. Do you remember what's the percentage earnings we had gain, Henny, for FLT on top of the head?
I can pull that up while you're.
Okay. So
Okay, it's O. It's
okay.
O.
Okay. So sales sales growth is about 7%, and earnings growth is about 11% this quarter compared to last year, the same quarter. Overall, I think the company is doing well, even though the SSG showing is a buy, but I do recommend to hold. The reason why is, well, if it's for your personal portfolio, especially if you're retired, I would think that the stock will be a good income stock because this company is a monthly paid dividends company. They have a trademark, so the O is monthly dividend company. Anyway, as for if you're looking for growth stock, I think I will kind of I think I will think further. So like for me personally, I have not invested in O, even though I follow it. I'm still watching, because I listed in my report the reason why my consideration not to buy is because it's just complicated, especially when there's interest rates going up. I still don't quite understand digesting how interest rates going to affect REITs. Anyway, but companies itself is doing well, and they are re-renting their properties, and they are seem like it's in REITs industry they are a top performer to me. Sounds to me.
There's a good
Jay,
discussion. Morningstar reality income also.
Say it again.
Jay,
reality income's followed by Morningstar quite well. So I've been following for the last 5 years, and they make quite a few comments. So it might be a good place to look.
Okay, are they a positive comments?
No, actually, they went up about 80%, and that's when I sold it because I said, how can a company that grows at 6% go up 80%? And then all of a sudden, everything reversed when interest rates went up. All the income stocks have plummeted. So it really is related to, I think, interest rates.
Yeah.
PSA.
Okay.
Another problem is taxes.
PSA. We're not discussing. Okay. My stock is PSA. Sorry, I'm just trying to get it so Hanny can have his time. Okay, so we also have to vote on and discuss the other stocks. So PSA, I think I did change the estimated sales and historical EPS. And
Joanne, what kind of real estate do they hold?
Storage units.
Right.
And they claim that they're interest rate resilient. You know how we hear that REITs are sensitive to interest rates? They claim that their type of REIT is interest rate resilient because it doesn't lock itself into set storage rates for long periods of time, and it gives it the ability to adjust quickly to whatever economic conditions like interest rates and inflation. But I do, it is in a buy, but my recommendation is a long-term hold as a defensive stock. If I know our club, the emphasis is on growth stocks, but they do have a consistent dividend. And but in the case of if we want to put our whole portfolio into growth stocks, then it would be the buy is not recommended. And we can go on to Hanny. Give you an extra minute, Hanny.
2 minutes.
Okay.
Okay.
Oh, I think we should consider all of these REITs with the taxes. The dividends are not taxed at a good rate, so they're high tax rate on the dividends in these REITs. I understand.
Okay. It's Hanny's time.
Okay.
That's a good point, Bernard. That's a good point.
Yes.
So just very quickly on High Crush, I want to remind everybody why we bought it in the first place. It's a cyclical stock. We wanted to study cyclical stocks. They don't they're not easily analyzed using the SSG. So we wanted to see how maybe to go about doing that. That was the reason primarily for holding the stock. We've done quite well with this. We've gotten over a 50% return. Looking at the macro conditions, not necessarily the SSG, but the macro conditions, there's a lot of oil and gas wells being drilled in the Permian Basin area. The problem they're having, a number of issues. One is pipeline capacity is at a maximum, and until new pipelines are built, they're going to be storing their production, and so that is going to lower the price of that oil relative to other oil from other areas. The other thing is, because there's so much activity in the Permian Basin in Texas, there's a shortage of labor, and operating costs have gone up significantly. There's also, because there's less pipeline capacity, they're resorting to train shipments to move the oil out, which is making trains less available for the sand that they use for fracking. So there's a number of sort of compounding effects. And I think that the price of high crush has reached a peak. They're predicting next year that both earnings and sales will decrease for some of the reasons that I mentioned. So I think we should take profit while we can. We have a good return on it. It's a cyclical stock. There's a lot of uncertainty around oil prices, a lot of uncertainty with respect to environmental issues related to building new pipelines. So I'm not really sure how this company will do going forward. My advice is to sell now. That's it. Thank you.
Perfect. Oh, we got extra.
Okay, so we can move on to our voting discussion now.
We have now finished discussion on the Tencent. So I cannot. So give Jane a little bit extra time because she really have not finished her stock. I felt, don't you think? So we were still looking at her SSG. Can we pull out the Tencent SSG, please?
Yeah, I'm pulling it out right now.
Because I felt her sales 40% is way too high.
Did you switch it over to Jane?
No, we are looking at your screen. No, I have not.
Oh, do you want to look at her screen?
Doesn't matter. Yeah. I can look at your screen. Maybe your network is better. Joanne, do you have it?
Her screen?
Yeah. Do you have her SSG?
No.
Okay. Then look at her screen.
Yeah.
Okay.
Okay. So can you see my screen right now?
Yes, we can see the screen. Can we, first of all, there's two issues. Number one is projection. Number two, John had a question about your PE. So what if we just cut the sales to 20% or 15%? What happens?
Okay. Take a look at the PE first. John, where do you see a higher PE?
No, what I'm saying is, I'm just saying that your current price earnings ratio at the bottom says 44.3, right?
Yes.
Your average price earnings ratio is 35.8.
Yes.
What I always try to do is to not buy above the average PE as a safeguard. And so I use that as I don't always adhere to it, but I've heard that for 20 years. So when you have a higher PE, because when you went down and you figured out what your return was, you said your return using the average PE would be such and such. Well, if you're not, but you're not at the average PE, you're way above the average PE.
Can you go back to the screen again?
Yeah, sure.
Second page, he's still talking. Yes, here.
So
John, what's your recommendation for high PE?
Well, I'm not saying it should or shouldn't be. I'm just saying that when you're above the average PE and you're going to buy above the average, see down below it says price return for average PE is 30%. We're not at the average PE. We're significantly above the average PE. So our projected return is not going to be 30% because we're buying higher than the average PE.
Yes, I understand. Actually, by the way, John's going to give an education topic on this actual average PE next month.
Having told you how important it is, I'm going to tell you it doesn't exist.
Right. I see what you're saying.
Yeah.
So Jane,
so anyway,
what he was saying that your current PE is at 44, your average PE 35, your high PE is at 41. But with that 30% return, actually it's not at the average PE.
So it says projected return average PE is 30%.
Yeah.
So that's using the average PE, right?
Right.
Yeah.
We're not at the average PE. We're above the average PE right now. You just told me that the PE right now is 43, not whatever it was. And so your return is going to be less because you're not at that lower PE.
Yeah.
The average PE is
35.8.
Yeah, it says it right there. That's why they have that there. It's because I always thought it was.
Okay, 35.8. I see.
Yeah.
Okay.
So when you go down here, it says your return at the average PE would be. Okay. Now my question is that the average PE went at 5 years from now if it hits the average PE?
35.8. You mean 35.8?
In other words, 5 years from now, if the PE is 35.8, will we have made that return 30% per year? Or is that the return if you buy it at the average PE? That's my question.
That's the return. That's the return. No, that's the return if the PE remain as the average PE of 35.
Right. In other words, 5 years from now, if the PE is 35.8, you'll have made a 30% return.
That's right.
Okay. So my next thing is that usually when, again, as a safeguard, I've heard this in more lectures over the years than I can tell you, and I came up with this a long time ago. I'm not saying it's always the case, but usually when I buy above the average PE, I rationalize why I'm doing that because you don't have that buffer of safety.
So how am I buying above average PE right now? Because the average
current PE is 44.3 and the average is 35.8. So yes, you're buying above the average PE.
The current PE. Oh, okay. So you are taking the current price?
No, the current PE. It's right on your chart right there. It says current price earnings ratio is 44.3 using the current price, right?
Oh,
but the average PE is 35.8. And so it usually use the average PE, and at least I've done that for 20 years. I've always said, am I buying above the average PE? It's like a safeguard, and I've heard that in lecture after lecture. It doesn't mean you can't do it. It's just that I usually try to figure out, well, why am I doing that? And most of the time, it's hard to buy the average PE when a stock grows so quickly. For the
I see. I know what you mean now. Okay, I understand. But again, we understand this is a growing company. So it has a big potential and it's making profit. It's not like Amazon, you know, it's really growing and showing a profit.
Right,
so,
but my point is that that's kind of like a golden rule I've heard for 20 years. So I don't know if anybody else has heard it.
So John, to say what you're saying in a different way, there's a book called What Works on Wall Street by
I've read it,
Shaughnessy. Yeah. So I mean, that's what he espouses in the book. Is he's done a statistical analysis, and when you buy at a high PE, historically, you will in the long run lose money.
Right. So upside downside ratio is one thing, but I thought the other half of the equation was average price earnings ratio.
So you could put.
I would like to change the sales, and when you change the sales, it will change the earnings, and that's high. This and then you will.
What could be done is put in an order at a limit price that reflects the average PE.
Yeah, it will, right? No, average PE. Wait, no.
Use a limit order. And limit
we don't do limit order. We don't do it.
I don't like limit order.
No, we don't do limit order. You can do it on your own, but as a club, we don't. So can we change the sales? Just say 20%.
I did. It's a whole, but I think 20% is probably too low. Can we do like 30?
Wait, hold on. You say sales is a 20%. Earnings is a 38.5.
If I change to 20, the sales projected.
Okay,
right?
can you change earning per share? Hold on, just a second. Come back. Okay, and then can you click the box for earnings? So everything else remains. So 18.7 is the earnings. Okay, and then can you go back to the second page now?
Yeah.
So
it doesn't change the average PE when you change the PE.
It doesn't change. No, it doesn't, because average PE is a high PE and low PE is average. So I was wondering, But you know what? I kind of, yeah, maybe 20 is low.
What's appropriate to do sometimes is say, what would be the PE with one more forward year of earnings in a fast-growing company rather. So if you look at the earnings a year from now and divide the price, you might end up with a PE that's a little closer to 35.8. So that's how I've rationalized in the past to grow a company that grows really quickly. Because as I'm going to show next month, sometimes you never see the average price earnings ratio, but it still should be in the back of your mind as a sort of level which you want to try to stay below for safety.
Okay,
Now,
are you okay? Are you agree? Do you agree with 41 high PE?
It says
High PE in the 41. Do you agree with that?
Yeah.
Okay, so can you go back to the sales growth again? I want to take a look. Last year, I don't know what's last year's sales. Do you know what they are? Okay, last year sales is what they only have a number. I don't have a percentage. Okay, 37, 50, 49. So, okay, 39, 42, 44. I would just try to want to. Okay, can you change? What if you gave 25% or 30%? What happens?
Yep.
yeah. Now, I have a question about this compound annual return using average PE.
Uh-huh.
Yeah.
Because if I look down at the bottom, it says using forecast average PE. It doesn't say historical. It says forecast, and that should change when we change our forecast.
No, you can't change the average PE's got to stay the same. You can't forecast it in the future.
Well, it said, but this compound annual it says compound annual return using forecast average.
Right.
So,
yeah.
so we are forecasting high PE and low PE.
Right.
I mean, that's what we do on our judgments.
Yeah, and also it's telling you what the return will be at the average PE 5 years from now at the earnings we're assuming.
Right, but we're not. You're talking about PE, but if we change our assumptions, it's the forecast average will change.
Yeah, but that's why we call it the average PE, because it's supposed to. We have to have some anchor to hold us to a level even in the future. So we're assuming that the average PE is going to occur in the future too.
Yeah, I agree with John to be prudent. However, you have to look at what company we are looking at. This is technology company.
Okay, one more minute for discussion, and then we have to vote.
Another thing, John, you just recently invested in this company. Can you tell us what you learned about this company from Morningstar or whatever? What you learned?
Everything she said was unbelievably. I mean, it put it together really nicely. I mean, I couldn't be more complete than what she said. It was a beautiful discussion. My only question was the average price earnings ratio, and the reason I was asking is that I hate to break that rule. So when I do, I try to rationalize it in some way, even though maybe I'm fooling myself. And I looked ahead for a year's worth of earnings in the future. If you don't do that, which I'm going to show next month, sometimes for a fast-growing company, just like she said, you're never going to get the average PE. But a slower-growing company, I think it's more important to look for the average PE because it's not blasting off. And I'll explain next month that you're actually not.
5 seconds till voting.
Hold on, I have a question for Jean about the.
No, we have to vote.
I cannot vote because I need to understand about this company.
Well, we don't have time then.
Can I have one word? Because I think Tom is right. If the average PE in the future, if the high PE keep on growing, expanding, then the average PE will be changed. So
yeah, but we're assuming, but we just assumed the growth rate was something, so it's not going to do that because we're assuming that the growth rate is going to be a certain percentage. So the PE in the future should be the same. The high and the low PE in the future should be the same, and the average should be the same in the future.
I have to insist. I have to insist. We've got to cut our conversation and focus on whether or not we make a vote. If we don't want to vote, because I am going to close the meeting at 7:30.
So I just vote.
No, we can't discuss anymore.
I have a last question about understand the business about mobile pay.
You can discuss after the meeting.
That helps me to decide whether to invest or not. I want to understand mobile pay. So does this company make money from mobile pay?
Yeah.
Yes.
Okay.
They do.
Okay. Let's.
Oh, this company. I'm sorry. I thought you meant. No, I think I answered for the wrong company. Never mind. Forget what I said. I don't know.
I said T-cent.
I thought you meant FLT. Sorry.
No. I want to know.
Average PE will expand.
We can talk about average PE this for next education
topic.
topic.
Expand. I can show you next month. It doesn't expand.
Let's start voting.
Yes,
Okay.
somebody make a, a motion.
I make a motion to buy. Oh, can I make a motion?
To buy what?
To buy the Tencent.
10 cent?
Tencent.
Tencent.
Yeah, Tencent.
Before we buy, we
I
should
second.
sell. We should follow through and sell if we're going to sell something, and then we know how much money we have. So I think we should do our motions to sell first, and I think Haney was recommending something to sell. We should vote on that, and then we can go vote on buying.
We actually have lots of money. We have 4,900 cash and an additional 1,000 from this month. We have money.
I think we have 3,000 cash.
3,000.
Three plus.
I thought you
Plus.
planned for it. I could be wrong. Okay.
3,000 and then 1,000 from this month.
Okay. So
I
we
don't buy.
Less than 10 cents.
And normally we're sitting around with a lot of cash, and I don't think that Better Investing, they like that. I think you're supposed to be fully invested.
I know
So
we
I
want to
think
invest,
there's-
but we did not find things to invest in the prior month, which that is also McQueenie's question. Is there any reason why we keep cash on hand? No, we don't want to. We want to invest, but somehow in the past, we did not
Well-
find the right company to invest in the past, or some company it isn't buy, but
Okay,
they already
we
have a
have
large
4 minutes.
portion
4
of the
minutes
portfolio.
to vote.
I think we should make our sales before we make our buys.
That's fine
That's-
too.
Yes. Okay, good.
Well, don't we have a motion in a second to buy 10 cent?
Yeah.
Yes, second.
Okay, then vote.
Whoa.
Use your voting ballot.
Okay.
Uh-oh.
I'm having a little trouble here. I have my ballot, but I can't put in my email address.
Yeah, me too. Weird.
Can you just submit it without an email address?
No, it's something I changed. I'm not able to submit. I think probably everybody has the same question, same issue. Is it? Can
I
you
just
vote,
read-
everybody?
I'm having the same issue.
Yeah. Did you?
No, I can't vote.
Okay, hold
So,
on.
Jay, can you send it out?
Yes, I will send out.
Yeah.
I can't put in my email.
Hold on.
Okay, now I
Yes,
know.
you can. I got it. So let me
Resending
send it to you. I'm sending right now. Just a second.
Yeah.
I have to go again to email? Okay, I guess.
Okay, sent.
Okay. Yeah.
It wants me to put, I can't.
Yeah. Okay. Okay.
I can't put in my email.
No, don't use that
Don't
one.
use the one that Joanne sent.
Use the new one.
Use the new
Use the
one.
new one
Yes.
that Jay just sent.
Right. Joy, you cannot share link. You have, yeah.
Okay, I voted. It
Yeah, we
worked.
got yours, Tom.
I voted.
Yes. I can.
What was the
motion again?
Well, okay.
The
So
Buy
motion
10
is
cent.
to buy $1,000 of a T. Oh, how much are you? We have a money.
I thought we were selling.
Jane, how much?
the motion?
The motion was by, I don't know how much. Jane, did you say 1,000? Did you specify the amount?
No, I didn't because I'm not quite sure how much you want to.
Let's go wild and do 2,000.
Okay.
Yeah.
The motion is to buy $2,000 of a 10 cent.
Yes.
okay, I can't vote. Mine don't work. So I'm just gonna say yes.
Okay. Okay.
Mine doesn't work either. I'm saying yes. Gordon's
Okay,
line.
John, you need to go to check your email again, the one that I just sent.
I did. It didn't work the second time. I just did it. It doesn't work. I don't know why.
3 times. I've done it 3 times.
Okay. We have 1
Okay,
minute left. It looks like,
I'd like to make a motion to sell High Crush.
I second the motion.
I third it.
Okay. Do it quickly because we only have 1 more minute left.
Now it's
It's
telling me
possible
I've
if
already
time
reached-
Hold on. Okay, go ahead.
If there's
Vote.
if there's time after as well, motion to buy.
Oh, there
these.
I am. There I
I
am.
vote yes. I can't do my
Okay,
email, but I
we've
vote
got
yes.
yours, Bernard. We've got yours, Bernard.
Mine's telling me I already responded. Do we need to do something? Now maybe it's working.
It's working right now. I just deleted the. Okay. So okay, Tom, you okay? There you go. Wait, Tom, you have
So,
not. Okay,
so
Tom.
the first motion.
Also, if there's time, motion to buy Disney.
Yes. So motion passed to sell High Crush.
Yeah.
And the motion passed to
Buy Tencent.
buy Tencent.
Okay.
Okay,
So
we're done. We're done, people.
okay. And
Sorry.
so wait, do you want? So are we continue to have motion to buy or no?
No.
If
We're done.
possible.
We gotta be diligent about closing the meeting out at an hour and a half. Just so.
I agree with
Sorry.
you, but then we do need to be
No.
diligent about. Are we going to? So how do you want me to stop the recording?
Yes.